The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, I think the question is there any sort of weather premium in this grain and oilseed market trade? Kind of choppy action at midweek on Wednesday. The wheat market did try to take leadership on the session while quarter beans were mixed. Also, what happened in cattle futures? We kind of broke to the downside late in the session and finished with triple-digit losses there. Let's talk about things. Joining us for a conversation and analysis today, Mike Zuzolo, Global Commodity Analytics. Mike, good to catch up with you again this week. So let's start there. Is there any weather premium to speak of in these grain markets, Mike?
I think, Jesse, the way I'd look at it is if you look at the global stocks from the USDA report and you look at the global weather, I think we finally got some traction on both of those things here at midweek. And I don't think it's any coincidence that we saw this wheat-led turnaround start on Tuesday mildly and then really kick into a higher gear in hard red, leading it on Wednesday as the May futures went off the board here on the 14th of May. And I think this is where, if I had to take a couple days back or a couple weeks back, what I'd say to everybody is I think we've been trading mostly U.S. fundamentals, U.S. weather, U.S. crop progress, U.S. biofuel policy. One of the things that, gave the beans the chance to get to a 9-month high this week was the extension potentially of the 45Z by the U.S. House of Representatives. And that all aided in what I think was a program sell by the funds in May all the way through the May futures expiration. And this is really important, though, because what I told clients, two things since the U.S.-China trade thaw and since the WASDE numbers have come out. Number one, let the trade the U.S. fundamentals if they want to. We're going to hedge the world fundamentals, and we're going to use the world numbers and supply-demand fundamentals and the world weather to make my hedge recommendations. Number two, I think it's really critical for producers to realize that this trade has been really captivated once again by the wheat downside. And what I've noticed is by going to almost 5-year lows in the soft red wheat, that corresponded with about a 4-year low in the crude oil market. And this is why I think the funds were so heavily involved in this last break to the downside. If I'm wrong about this break being over with the May futures now off the board, Jesse, and we don't have a very good follow through the end of this week and early next week, we may be opening ourselves up to yet another leg down led by the wheat until we actually get in the combines and harvest wheat in the Northern Hemisphere. So I'm walking very tepidly, feeling good about the spreads, feeling good about the hard red wheat turning, feeling really, really good about the USDA world fundamentals and this U.S.-China trade thaw, but I really want to see some follow through.
Let's lean in. You mentioned a lot of these U.S. fundamentals that we've been tracking, but let's look at weather from a world perspective here a little bit. It's not just some drought concerns, I know, in Nebraska, for instance, and some parts of the plains, but you talk about the Black Sea, you talk about China and more. I mean, what stands out to you when you look at the weather drought scenarios from a world perspective, Mike?
Yeah, you see how closely aligned what's happening in the Northern Hemisphere is right now. And this is just kind of walking my talk about what I just talked about with you. Starting in China, left to right, we've got Henan province, which is responsible for about 30% of the wheat production in all of China because the winter wheat is such a large percentage of the overall wheat. It's looking at an extremely big drought situation brewing, and it's been Henan and China in particular has been the one that I think the market is most underplayed and not priced in. To your first question, why would that be? Because of the U.S.-China trade relationship. Well, now that we've thawed and we think pretty seriously that China's been buying wheat from Australia, maybe from Canada, feed barley from some countries as well, maybe, just maybe, we'll start to see China come in for U.S. wheat now that we've got this 90-day thaw. This map right here is a blow up of China, and in that dark orange is the Henan and Anhui provinces. again, both of those together make up about 40 to 50% of the winter wheat production. The neat thing about this, though, Jesse, is this is coming straight from the Global Times out of China. They're acknowledging how bad the drought conditions are. And some of these provinces are going back to what they did back in the 90s and early 2000s. They're firing rockets with mercury into the clouds to try and stimulate rain. So whenever that happens, it tends to get my attention.
No, that's very true. Well, and then kind of coming back to what you were initially looking at, just the connection between, everything that's happening in the northern hemisphere here. And I mean, you can kind of see as we look at this on the video feed, that line drawn pretty parallel, with the plains, China, and then over to the Black Sea, Europe regions. I mean, there's a lot of nuggets here, I guess, that kind of fit together in the puzzle, I would say, Mike.
It really does. And, the Ag Ministry of Russia came out on Wednesday and said, oh, this recent frost probably didn't hurt us much, maybe 10% of the crop, nothing like last year. Well, private sources are suggesting the exact opposite, that this was a longer duration hard freeze. They got down into the negative 13 to 15 degree temperatures for over 7-8 hours on a couple different occasions in both the winter wheat belt of Russia and Ukraine, and that the damage could be very, very serious. And I think when you look at this map, what I thought of, Jesse, was what you just pointed out, and also why would the trade not care about what was happening, except in what was happening in Nebraska? And again, I think it goes back to these trade fears and this trade relationship between the U.S. and China, especially, probably masked some of these world scenarios. And that's why I think it's extra timely with the May expiration, with the funds adding to their net shorts and wheat especially. And now that we've got USDA's numbers suggesting that demand is not backing down. That was the biggest shock of the week, that I thought the trade didn't trade, was they're not backing down at all on world consumption for agriculture, grains, and commodities at this point, with or without the tariffs. So the question is, how much did they plan in or bake into the cake, the tariffs? My answer would be, based upon looking at 4 different documents, not a lot. Having that being said, it's still very impressive that they put in record world consumption for some of these grains.
Let's talk corn. Corn has felt very choppy to me as of late, but you brought this up in the open, and, thinking about stocks to use and some of the numbers we have, and we'll get into the spread action here in a minute, but walk me through what you're watching in this corn market now post WASDE report, and with the thoughts of, weather premium or not in these grain markets.
Well, we're running really ahead of schedule in planting for corn, and I think that's part of the reason why the trade had been focused on buying beans and selling corn so aggressively. I've got 6 out of 18 states running 20% or more ahead of last year's schedule on corn planting. You add to that the fact that in the WASDE report, USDA raised Paraguay's corn. They also raised Brazil's corn production for this current crop that's growing right now, and second crop, by 4 million metric tons. I've still got people in South America saying that is what they hope if they have ideal weather from here on out. But the trade, I think, really took hold of those two things, and that's why the spread gave way and the corn continued to leak, along with the wheat pulling it lower after the report. But when I saw this number of this 21%, 21.8% stocks to use ratio for world corn, because of that terrific demand and just a 1.8 billion bushel new crop carryover for the United States, that takes us down to levels not seen since our drought year of 2012. And as this chart shows you, the orange bars are the world ending stocks, not including the demand taken into consideration. 7 out of the last 9 years, we have not been able to build world ending stocks. We've actually gone deficit. And so now we find ourselves below a 22% stocks to use ratio, with a 181 national yield here in the United States and big acres. And that takes me right back to that global drought map when it comes to the wheat and the corn, and what's our real supply going to be by the time we get to this fall. And in the case of the wheat, what's it really going to be in the summertime? I've locked myself into the fact that I'm just going to hedge wheat off the combine if I have to. If I can't have clients store it, hedge it off the combine and look to buy it back on paper.
Mike Zuzolo with Global Commodity Analytics is our guest analyst here today on Market Talk. Let's stay on the corn. That July D spread, it's it's been interesting here lately. And I think this goes to my thoughts on how we've been choppy and that spread has really tightened up. And I think even at one point this week, we were at a bit of an inverse here. I mean, talk about just some of the unusual spread action I feel like we've maybe been seeing here lately, Mike.
Yeah, this is my number one watch list item at this point, Jesse, when it comes to what we've been talking about. As you said, after the report, the July cratered against the December, and we went negative, which means the July lost all of its premium and pushed it into the new crop. That is a strong signal traditionally to producers to store and not sell because they don't need it at the end user level. The demand's not there. It's a very strong indicator at the fund and investor level that this is a rally that is to be sold on any a market to be sold on any rallies. And so that's why this downtrending line that we're now breaking through as of Wednesday's close, getting back to 4.5, 5 cents premium to July, premium to the old crop, as July now takes over as lead month futures from the May. We want this thing to hum. We want this breakout to continue. And I would like to see us back around 25 to 30 cents premium to the July at kind of a minimum, given these end stock fundamentals and this question mark about the global supply demand. I guess what I'm saying at this point, USDA and the China trade thaw would suggest to me pretty strongly that these drought issues would suggest that we need to ration demand for those countries that have excess corn. Those countries are going to be Brazil coming on, but not for a few more months, and especially the United States. And that I think the spread needs to do that and send the exact opposite signal to the trade and to the producers saying, give us your corn right now. Don't store it because we need to meet this demand. So that's what I'd really like to see is a demand rationing type spread where July gets 25 to 35, maybe even back up towards those highs of 45 cents premium to the December.
Any other thoughts on the soy complex before we spend some time with cattle? We had soy a little bit higher. Bean oils obviously got some support from the 45Z talk with the House you mentioned and more. Any notes for you when it comes to the soy complex, Mike?
Yeah, I'm glad you asked. Two things. I'm very glad that the funds have put so much of a net short position in place, and now the Chinese have acknowledged that they're going to cut back on their meal usage in their livestock feed to try and save money. I'm hoping that the meal market is done with it being ravaged to the downside, another key indicator in terms of corn and meal working together. Secondly, I would say this week once again showed me, Jesse, that if the beans want to go above these recent highs of 1050 and stretch their legs to 1075 or the next resistance of around 1105, I really think they need the wheat and they need the corn. The world fundamentals for beans, and this goes back to my initial point, we're still dealing with a record high, modern day record high ending stocks number. We added 1 million metric tons and went up to 124 now for world soybean ending stocks for 25-26. I'm a hedger in beans. I want to see if the wheat and the corn can't get us a little bit more out of it.
All right, let's go to livestock. Let's talk cattle. And you and I were discussing this off air, trying to find a headline or something that was maybe the reason why cattle futures broke lower late in the session on Wednesday. We had feeders down 3 to 4. Fat cattle were 1 to 2 lower. I mean, we're still at record high levels here and really have just continued to see this cattle market just go gangbusters here, so to speak. And I mean, as we look at the June live cattle chart, I mean, it almost felt like a bit of a consolidation, maybe some profit taking late on Wednesday's session overall, Mike. I'm not quite sure.
Yeah, I think this is a really big wait and see market, not unlike what we've been talking about with the corn and the spread. A little bit different in that the Mexico border being closed to the feeder imports fed the bull and feeders. The Wall Street rally back to pre-April 2 levels in the S&P 500 especially fed the bull in the fat cattle. Packers still appear to be pretty short bought. That is feeding the cash bull. The 5 area number that I've been hearing this week is that we're going to break through 222 and get to 224. That 350 choice box beef number would suggest that's very possible. You throw, and then you have the USDA coming in with the 2026 average steer price of 223, which is $7.50 higher than 2025, our current year. I think all this adds up to, if you break here, you probably need to get some sales in place or sell this market with tight stops above the recent highs, above these record highs that we made on Wednesday, because this could be one of those telltale signs where you've thrown the kitchen sink in there as far as bullishness and the funds are just done buying. You just don't know at these record high prices. That's why I like this June cattle chart. I like the cycle. I know every year is different, but this has a pretty good cycle price action to it, especially since we came into the new year, into 2025. So we're leaning towards the downside in the cycle. This matches up with box beef prices tending to top right around this time period. And then in the stochastics, the oscillators at the bottom, the white and the orange lines have crossed. That could be a pretty strong indication to the funds. No new buyers coming in at this point. So we're now trading in fat cattle a outside week lower. We made a new record high on Wednesday, and then we followed it with a new weekly low on Wednesday afternoon close. So that $300 level is going to be really important to the feeders. When you look at the fats, it's going to be those highs that we just came out of in terms of about a week and a half ago. Otherwise, you could slip back down to that second blue line where those highs from April are. And so that's kind of what I'm watching here going into the end of the week. Is it could have been a gap filling day, but we don't want it to last more than a day or two. Otherwise, it looks like it could build some momentum.
Yeah, that's a great point. Feeder fat spread. Let's just touch on this real quick as well. This is something we've been tracking for a while. Any key things stand out to you here?
Yeah, we've really stretched our legs getting upwards of earlier in the week. I think we were trading 86, 87 May feeders premium to the June fats. And you notice that gets us well above where we were in 2014, 2015 of about $75, $80. But it's really clear by this chart that at this point in time, this being a monthly chart, the feeders have led the fats higher. If the feeders break, and I think they will be the ones that break first, like what happened in 2014, I take that at face value and say, okay, it's time to get some hedges in place. And this is going to be this next 6 months, Jesse, I feel pretty strongly, because I don't know if the Wall Street market really has much legs after this last go round and this trade thaw with the U.S. and China. But between the bond markets, Wall Street, and just the sheer prices we're at going into summer grilling season, and the fact that USDA could say, okay, Mexico's done what they're supposed to with screwworm, we're opening our border up at the end of this month. I think you're really going to have to be more active on selling and then defending that sale if the market goes back up again. And that's why, again, we talked about this last week. I'd really explore options other than LRP at this point, or options that are included or on top of LRP, especially as you get close to futures expirations when the options get cheaper.
And I'll pose this question to you. I made this statement / question yesterday on the show. We keep talking about trying to protect yourself in this cattle market. We don't know when the fun is going to stop, but what do you say to someone who we've been, screaming at them to get hedged for months now and they haven't done so? I mean, it's, I think some folks might still be out there just kind of, laughing and chuckling and not protecting themselves, Mike.
Yeah, I mean, this is where you could always be right about saying this time is different, but we never have ever had a time where this time is different. I mean, I remember in corn talking about the ethanol and how we're at new demand plateaus, never go back below $5, blah, 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 blah. I think it goes back to the consumer side of the equation. And there's only going to be so much the global consumer can take at this point. And we're rebuilding the poultry flock. The avian influenza is not as bad. The egg prices are coming down. The inflation numbers showed that this week. And we're rebuilding the hog herd around the world as fast as we possibly can. So my answer would be, this is an ideal scenario where bought puts really work well historically, because you can just keep rolling those up. In other words, take a loss of $1 or $2 on a put after an $8 or $10 rally in the futures. Do that 3 times. You're out, $5, theoretically speaking. If you include all your costs, you're out $5 on a couple 3 put rolls, but all of a sudden you've gotten $25 better when it comes to, or $30 better when it comes to your floor price. That's, in my experience, the only way I've been able to tangle with these kind of markets and not leave myself wide open to a sharp slide to the downside of 10, 15, or 20%, which I think we're going to see one or two of those this year.
Mike, final thoughts. Great conversation as always. Anything else you would add today?
I just roll back to what we talked about with the wheat and the crude oil markets, Jesse, that U.S.-China trade thaw should have done a lot to both of those markets. I want to see that action, especially given this global weather and the fact that the U.S. dollar has not been bought aggressively. It had a couple big days, but now it's locked back into kind of a range.
Mike, if folks want to reach out and take a look at your analysis and more, what's the best way?
Great time to do it because there's a lot of specifics, a lot of analysis being pushed out. Globalcomresearch.com, globalcom with 2M's research.com. Sign up for a 2-week free trial. You won't get everything, but you'll get the flavor of what we do.
Mike Zuzolo, Global Commodity Analytics. Always good to hear from you, sir. Have a great week, and we will talk to you next week.
You too, Jesse. Thanks for having me.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.